Welcome to Geojit Spotlight. In recent months, Jane Street Group, a US-based proprietary trading giant known for its high-frequency trading strategies, has come under intense scrutiny in India. SEBI has now barred it from participating in the Indian stock market and ordered it to return unlawful gains of 4,843 crore for allegedly manipulating stock indices through derivative positions. Let me briefly try to describe what the controversy is about. Let's start with something fundamental: arbitrage. Arbitrage, simply put, is when a trader spots a price difference between two related markets and takes advantage of it, buying low in one and selling high in the other. It's supposed to be risk-free, and when done honestly, it strengthens the market. Let me give you an example. Imagine the Bank Nifty index is trading at Rs 100. A call option gives you the right to buy it at 90 rupees, and let's say that the option premium is 6 rupees. Your total cost is 96 rupees. If you exercise that option and immediately sell at Rs 100, you make a neat 4 rupee profit. That is arbitrage using call. But the issue that SEBI order speaks about is not about legitimate arbitrage. It's about alleged manipulation. About powerful players not just sporting price mismatches but creating them. Jane Street, according to SEBI, didn't just wait for a profitable opportunity, they allegedly engineered it. On expiry days, they would buy index futures and large cap stocks aggressively in the morning. That broke the market, making some put options very cheap. So they bought those puts early, and then later in the day, they reversed their buying, selling off those positions, dragging the index down. As the market fell, the puts they had purchased earlier suddenly became highly profitable. On paper, it might look like a smart arbitrage trade, but when you cause the price to swing yourself, that is not arbitrage, that is manipulation. But the question that matters to us most is, will the ban on Jane Street affect trading volumes? To understand this, we need to look at the influence of high-frequency traders today in Indian market. They account for about 50 to 60% of the trading volume in India's equity derivatives market. According to Money Control, when NSE issued a caution letter to Jane Street regarding its trades which appeared to be manipulative, it had almost completely stopped trading for 2 to 3 weeks. We checked the volumes of February 2025 NSE and found that in the first week, the daily average number of contracts traded in the index options segment was 9.8 crores. This in fact rose to 12 crores in the next week, when Jane Street was not present. The figures for the next 2 weeks were 10.2 and 9.3 crores respectively. This could mean that other high-frequency traders probably increased activity when Jane Street was not there. So what can you expect going forward? We should certainly expect more vigil from SEBI and exchanges, especially on expiry-day volatility and index manipulations. And FPIs could be more cautious with their strategies, obviously. Volumes are in fact already down in the first few days of July after the implementation of new derivative rules. In this backdrop, let us not forget that option trading volumes in India declined 70% in the first 5 months of 2025 from a year ago period, as new rules on derivatives made it harder for retail traders to participate. So what would you choose, a manipulated market or an illiquid market? In our view, liquidity is very important for all market participants, be it traders, intermediaries or fintechs. But it is a structural aspect and can be fixed over time. Manipulation strikes at the core of the confidence and needs to be addressed immediately. So if the large players scale back their volumes, then we could expect lower bid-ask along the OTMs. And maybe at least a section of retail traders will stop seeing expiry day as a casino, chasing wild and irrational swings in prices. Or maybe this could pave way for better index construction, as the concentrated weights of some of the stocks in Bank Nifty was one of the aspects helping to move index easily. We believe markets have a way of self-correcting over time. Let's see.